The four-factor dividend growth portfolio had a pretty solid February, finishing the month with a return of 1.38%. For perspective, the S&P 500 finished the month with a return of minus 1.3%. So my little dividend portfolio outpaced the S&P by 2.68% in February. SCHD, on the other hand, had a pretty solid February, finishing the month with a gain of 2.55% and outpacing my portfolio by 1.17%. But a single month's return is a little meaningless in a long-term strategy. So let's take a look at the long-term results. Thus far, fiscal year number 3, that started in November of 2024, my portfolio is up 1.16% versus 4.84% for the S&P and 2.03% for SCHD. So not the greatest start, as my portfolio is trading both benchmarks. As we can see from the monthly returns, the bulk of this underperformance was in November and December of 2024. 2025 is thus far shaping up a little bit better. My portfolio is up 5.05% over the first 2 months of the year, versus a return of 1.44% for the S&P and 4.46% for SCHD. Looking at the more long-term return, since this portfolio was started on November 1st, 2022, my portfolio has a compounded annual growth rate of 18.81%, compared to a CAGR of 22.11% for the S&P and 10.53% for SCHD. So the four-factor strategy is marginally trailing the S&P, and it continues to maintain a pretty healthy lead over SCHD. Let's move on and talk about dividends for a second. The portfolio paid out just $1.21 in dividends in February, which was an all-time low since this portfolio was put in place. What I have seen thus far in fiscal year 3 is that the composition of this portfolio is creating a lot of variation in the amount of dividend income I am seeing from month to month. As you can see here, the portfolio paid out $9.57 in dividend income in January, which was the highest dividend income month since inception. Based on my projections, the first and the third month of every quarter should have high dividend income, and the second month should come in below average, which is okay with me because I'm more interested in how much dividend income this portfolio will produce in fiscal year 3 relative to fiscal year 2. Thus far, 4 months in, the dividend income for fiscal year 3 stands at $21.10, and the dividend income for the first 4 months of fiscal year 2 was $20.01. So we are a little bit ahead, which is good. Since inception, the portfolio has generated $116.99 in dividend income. And as you can see here, from year to year, it's been growing pretty nicely. Another way to measure dividend growth is by looking at the projected annual dividend income. When the portfolio was launched on November 1st, 2022, the projected dividend income was $46.79. As of today, March 7th, the projected annual dividend income stands at $57.36. That is a 22.59% increase in dividend income. And if we annualize it over the 28 months of this portfolio's existence, we get a dividend growth rate of 9.12%. Currently, the portfolio is yielding 2.18%, and it has a 3.16% yield on cost. So while this portfolio does have a higher dividend yield than the S&P 500, it comes up a little bit short of SCHD. But I project that in the long run, because of the higher rate of return and the higher dividend growth rate, this portfolio will catch up to SCHD and surpass it in the amount of dividend income it will produce. I've been tracking how an equivalent investment into SCHD when this portfolio was started would be performing. As of month-end February, the SCHD equivalent portfolio would have a market value of $2,251, whereas the actual portfolio had a market value of $2,710. And this higher market valuation is also evident in the fact that the portfolio has a higher CAGR than SCHD. But in terms of dividend income, in fiscal year 1, my portfolio generated $41.29 in dividend income, whereas the SCHD equivalent portfolio would have paid out $64.63 in dividend income. So my portfolio paid out 36% less dividend income than SCHD would have. In fiscal year 2, my portfolio paid out $54.60 in dividend income, and the SCHD equivalent portfolio would have paid $75.09. So the margin of difference declined from 36% to 27%. That's still a pretty big gap to bridge, but at least we're moving in the right direction. Thus far, in fiscal year number 3, my portfolio has paid out $21.10 in dividend income, and the SCHD equivalent portfolio only paid out $20.67. So as of today, the portfolio is actually 2% ahead of SCHD. However, SCHD has only paid out one dividend since November 2024, whereas my portfolio has 4 months of dividend payments. So technically we're 1 month ahead. And when SCHD pays out its dividend at the end of March, it'll definitely move ahead of my portfolio. But it will be interesting to see if this declining pattern in the margin of difference will continue. Let's take a quick look at the individual holdings in this portfolio. During the month of February, the average return for the 20 stocks in this portfolio was 1.78%, which was 0.4% better than the actual portfolio's return. This margin of difference is due to the fact that I'm not rebalancing this portfolio each and every month. As you can see, each of the stocks in this portfolio has a different weight that is reflective of how each stock has performed since November. And because of this allocation shift, we have a margin of difference between my portfolio and the perfectly weighted portfolio. Thus far, the best performing stock in fiscal year number 3 is Visa, with a return of 25.57% through month-end February. We're also seeing pretty strong performance from Rollins that is up 11.86%, Paychex that is up 10.29%, Dick's Sporting Goods that is up 15.28%, and ADP that is just shy of a 10% return. Some of the detractors from performance are ConocoPhillips that is down 8.1%, Diamondback Energy that is down 9.64%, Monolithic Power Systems that is down 19.5%, Novo Nordisk that is down 19%, and Old Dominion Freight that is down 12%. The reason you're seeing 25 stocks on this list opposed to just the 20 that are in the portfolio is because in fiscal year number 2, the portfolio was actually made up of 25 stocks with a 4% allocation to each. And for fiscal year number 3, I decided to concentrate this portfolio even more, just around the top 20 ideas. But I also decided it would be useful to track if a 25 stock portfolio would have performed better. 4 months into fiscal year number 3, the 20 stock portfolio is still underperforming the 25 stock portfolio by 0.3%. However, it's worth noting that February was the first month when the top 20 stock portfolio outperformed the top 25 stock portfolio by 0.47%. This followed 3 months of underperformance for the top 20 stock portfolio relative to the top 25 stock portfolio. And it will be interesting to see where we are at the end of the fiscal year. Another pattern that has been shaping up in fiscal year 3 is that the best ranked stocks are underperforming the lower ranked stocks. After February, the average return for the top 10 ranked stocks is minus 3.6%, whereas the bottom 10 ranked stocks are up 6.6%. Now that we've looked at the portfolio and some of the individual metrics, let's talk about the strategy. The 4-factor strategy is an alternative strategy to SCHD. It's basically my own custom version of SCHD that is tailored to my investment philosophy. I personally prefer to invest in dividend stocks that are more growth-oriented, whereas SCHD focuses a little bit too much on yield and value. So to come up with the 4-factor strategy, I basically borrowed SCHD's methodology, and I tailored it to my investment philosophy. It's essentially a 2-step process. The first step is to come up with an investable universe of stocks. I do this by running a stock screener, and I look for the following 8 criteria. The stock must trade on the New York Stock Exchange or the Nasdaq. It must have a wide or narrow MOR rating for Morningstar. It must also have a standard or exemplary stewardship rating also for Morningstar. I screen for stocks that have a 5-year revenue growth rate of at least 5% and a 5-year earnings per share growth rate of at least 5% as well. Then I filter for a 3 and 5-year dividend growth rate of at least 5%. And the final criteria is a payout ratio of 80% or less. If I break down the criteria by what they're meant to accomplish, the first criteria of trading on the New York Stock Exchange or the Nasdaq is really an availability criteria, because I want to be able to actually invest in the ideas that I produce. The next 4 criteria, the Morningstar moat, the Morningstar stewardship, the revenue and earnings growth rate, are really quality-based metrics. And the final 3 criteria, the 3 and 5-year dividend growth rate and the payout ratio, are focused on dividends. On average, this screening process produces about 100 to 120 stocks per month. The second part of the process is to rank all of the stocks that this screener generates. And I do this by looking at 4 different financial metrics. Hence the name of the strategy, the 4-factor portfolio. Those 4 metrics are the free cash flow to total debt ratio, the 5-year dividend growth rate, the return on capital, and the forward dividend yield. And the ranking process aims to find the stocks that are the best across the board in all 4 metrics. Once the ranking process is complete and I have my top 20 stocks, the next step is to invest in these companies and hold them for 12 months. At the end of 12 months, I repeat the same process by running the stock screener and ranking the stocks and selecting the new 20 constituents in the portfolio. My personal portfolio that I showed you earlier runs on the November to October cycle. but I've been tracking the 4-factor strategy every month since June of 2023, mainly just to gather data, but also to see how other multi-cycles would perform. The initial results were pretty good. The June, July, and August 2023 4-factor lists all outperformed the S&P 500 and schd. Then the September, October, and November 2023 lists underperformed the S&P but still beat schd. The December 2023 list was the first one to underperform the S&P and schd, and that really started a pretty sour cycle for the 4-factor strategy. Pretty much from the end of 2023 all the way through 2024, the 4-factor strategy has been underperforming the S&P and schd. But more recently, in December of 2024, the 4-factor strategy has found its footing again. The top 20 selections for December 2024 are outperforming the S&P and schd, and the top 20 selections for January, February, and March of this year are all outperforming the S&P and marginally trailing schd. When I set this strategy in motion, I did realize that we would have better and worse years. And I told myself that I would run this strategy for at least 5 years and then evaluate how the process has worked out. So far, I've been pretty happy with the results. Having an 18.81% compounded annual growth rate over 28 months is pretty good. And really, when we complete the 5-year cycle, if this portfolio is generating a 12% plus CAGR, I'll be pretty happy. If anyone is interested, I do share this spreadsheet and the top 20 stocks selected at the end of each month on my Patreon. There is a link in the description below. Also, if you want to see more content from me, I do publish a newsletter called Quality at a Fair Price, where I publish my stock analysis and my research. There's a link to the newsletter in the description below as well. I hope you enjoyed the content. Thank you for watching and see you next time.